Good morning, everybody. Thank you for joining us today for a very important discussion around the issue of household savings, long-term savings, which is encouragingly beginning to attract more and more attention and interest in the Gulf region as well. As you know, Ibrahim, in different capacities, and Fintech Robos in recent years has been doing an annual pensions conference, and now, if you like, we have broadened the remit to household savings more generally. I think this is a very logical extension in the sense that people save for a lot more than their old age and their old age financial security, and I think in many ways the long-term savings, household savings perspective is the right perspective to have. If anything, the past year and a half has served as a painful reminder to all of us of the importance of building financial resilience, having some money in the bank, but also given the way government provision, social security provision, other things are changing globally, given the way labor markets are changing, I think there is an increasingly important case for everybody to have a savings plan and strategy, so that when these different needs come along, whether it's your first home or your car or your marriage or your children's education, savings are an important part of the equation. Of course, speaking as an economist, savings are also critically important for the broader economy. Savings turn into investment, and when we look at countries, mainly in the West, that have established systems for encouraging structured long-term savings, it is the vehicles that then manage this money, whether it is insurance funds or pension funds or other asset managers, that really dominate the capital markets and have a very important role to play in the way capital is allocated in the economy. And of course, that is an important story in the Gulf context as well, in as much as economic diversification will have to be top of the agenda for many years, decades to come, as these countries move to create and secure their long-term future in a world where oil and hydrocarbons will almost certainly play a very different role than they have over the past 50 to 100 years. So I'm very fortunate today in having a number of esteemed experts on the subject of pensions, of long-term savings, whether it is from the global perspective or more from the regional perspective, people who represent the industry, if you like, the asset management side, or the public sector, or the multilateral entities involved in this discussion. Throughout this conversation, I would like to invite the participants rather in this conference to pose questions, and those will be shown to us, and certainly feel free, all the panel members, to incorporate elements of those or pick them up in your discussion as we go along. We will also then try to allow some time towards the end of the panel to address some of those questions more explicitly. Apologies to those of you who feel that your questions don't get answered in sufficient detail. I'm sure we'll have many questions, but sadly we will have a limited amount of time for what is a very, very wide ranging conversation. Now, without further ado, let me briefly introduce our panelists, and then we will get started. We have Mr. Sherif Samy, who from Egypt, who is among his many responsibilities, the chairman of the National Asset Management and Investment, but has a long and distinguished career in public service and the financial sector in the country. We have Dr. Amlan Roy from London, who is the head of global macro research at SSGA. Again, one of many hats and a respected, recognized expert on pensions and long-term savings. And we have Chiara Monticone from the OECD in Paris, where she works as a senior policy analyst. And of course, the OECD, an organization that has played a very important role in shaping the policy agenda around long-term savings and pensions in the advanced economies, as well as more globally. So a lot of experience and expertise on the panel. We have a fourth panelist on the agenda, as you can see, Dr. Hana Bawazir from the University of Bahrain, Bahrain Economists Society, who is not with us yet. We have a plan B, if need be, so we can also then cover some of the local perspective on this important issue. Now, without further ado, we will start with some initial remarks from each one of the panelists from slightly different vantage points, and then move on to more general questions. Let's start with you, Amlan, if I may, given your global perspective from one of the global financial centers, and of course, an important global player in this space. When we look at the broader global backdrop for the long-term savings agenda, I suppose primarily from the retirement, aging, and growth challenges perspective, which of course is particularly and increasingly important for the advanced economies, but also globally. How would you characterize, how has the narrative in this area evolved in recent years? And what do these new economic realities mean for households in general, but then specifically in the advanced economies? And to what extent can we say that the situation in the rest of the world, which of course many people think of as younger, faster growing societies, that it really is all that different from what we are seeing in the advanced economies? Or should we just say that we are looking at the same picture, just the advanced economies are a little bit ahead of us? Over to you.
Okay, thank you. Check 1, 2, 3. I hope I'm audible. I would like to thank Fintech Robos, the long-term Savings Association of Arab Countries, and distinguished chairman, Dr. Jarmo, Kotilaine, along with my esteemed colleagues on this panel. I am an academic, but also a practitioner. So I want to take you back to what we teach in Macro 101, whether it's at PhD level or at undergrad level, when we talk about consumption and savings decisions. The foundations for this were laid by 3 Nobel Prize winning economists, all in the 1950s. The first one was Franco Modigliani, who talked about the life cycle hypothesis. Then we had Milton Friedman, who talked about the permanent income hypothesis, and Paul Samuelson, who related consumption and income to savings intergenerationally. The problems that they were trying to address is, take a household, they have incomes intertemporally over life, and they start earning probably at age 16. Those days, that's what was modeled. they work until age 64, and 65 plus is retirement. So over their life, they end up initially in their career borrowing a lot, then towards middle of their career saving a lot, and end of their career dissaving a lot. And that gave rise to the bequest motive. So that is the genesis of consumption. Now, I also want to highlight two other economists who are very, very important. They won recent Nobel Prizes, and friends of mine. One is Abhijit Banerjee and Esther Duflo from MIT, who talked about savings, consumption decisions of poor economies, and their bookseller, Poor Economics, was really their bestseller, laid the foundations for broadening what they found. How could they get people to save? How could they get people to be self-sufficient? And what lessons do we get from RCT, which is randomized control trial experiments? There was another person who talked about this called Angus Deaton from Princeton, and please read his book called Escape, Great Escape, and he talks about great escape from poverty, health, and all these kind of things. So that's the backdrop. Now, I want to highlight something that I've, for good or for bad, along with 20 economists and practitioners, we wrote it, and I've taken this around to 50 odd countries. It's called Age of Responsibility. This was written in 2015. Bob Merton of MIT is a co-author. And in this was done primarily for the UK economy. The pensions minister is a contributor. I'm contributor number 2. Bob Merton is contributor number 12. And there are 18 co-contributors. Why was this written? This was written because UK faced a very, very severe challenge, saying we are saving very little. We are going to have Brexit. We don't have capital markets, which can take in a lot of domestic savings and translate it. We need that kind of savings to build infrastructure of UK, which is very old, not to say that US is not very old. And this is called Age of Responsibility. And the saying behind it is very, very German. And for that, I thank Ibrahim for inviting me and Jarmo for allowing me to be on this panel. The saying at the end of this book, and this is roughly 300 pages, it's been presented to the US Department of Labor, to the Nordic Pension Society, to the Department of Labor in Sweden, etc. Says, a society grows wise when old people start planting trees, knowing they will not benefit from the shade of those trees. This is an old Greek saying, and I used it first in Greece in 2010, 2012, saying that we need to think longer term. We need to think about multiple generations. And for the first time, we are at a time in our lifespans where 5 generations exist. So I'll give you an example given to the Mexican regulator about a year and a half ago. 5 generations exist because in Brazil, we have a 91-year-old retiree who's an ex-army officer. The 91-year-old retiree has a 67-year-old daughter. 67-year-old daughter has a 44-year-old son who has a 20-year-old daughter with 1-year-old twins. 5 generations exist, of which only 1 generation is working. Changing life cycles, changing generations, and changing longevity. So as a pensions and demographics expert, I will give you numbers later on, also Bahrain, etc. But why wait for it? I will just give you the numbers. In the last 4 decades, Bahrain's life expectancy has increased from 70 to 77.72, which is 78. Kuwait from 70 to 76. Oman from 62, way behind, to now 79. So Oman has leapfrogged Bahrain and Kuwait in terms of life expectancy. Qatar was 74, it's now at 80.71, and UAE from 70 has gone to 78.4. We should not just be worried about the fact that life expectancy at birth is high. What I also have out here is life expectancy at age 65. That in Bahrain used to be 13, and today is 17. That used to be 13 in UAE, now is 18. Used to be in Qatar, 16, 18. So we are looking at 18 years post-retirement. Now I'm going to tell you something that is a legacy of mine, like it or leave it. And in European Commission, as well as IMF, I'm known for that. Also at the OECD in pensions, Pablo Antolin, as well as the chief economist know me for that. That is we have an unsustainable fiscal system. All the fiscal promises on pensions, healthcare, long-term care, even in the richest of countries, the Nordic countries, are unsustainable over the next 20, 30 years, and therefore we need to renegotiate a lot of those. One of the renegotiation things which will help is if people start saving more. People are living longer, but they're retiring earlier, and they have 20, 25, and in the key example that I give of Japan, the conditional probability that a 70-year-old live till 90 or beyond, according to Nippon Life, is 0.8. So there's an 80% probability that a 70-year-old today is going to live till 90. So I want to ask the panel a question that 19 Nobel laureates have not answered, but you need to think about it, and everyone needs to. Jarmo tells me, Amlan, you're age 65, please retire at 65. Ibrahim and Chiara tell me, Amlan, you'll die when you're 85. So I retire at 65, I die when I'm 85. First person who I posed this question to was Modigliani, second Samuelson. How much money do I need for 20 years post-retirement? Because Jarmo clearly said, I need to save. And I agree with him, I need to save. Chiara and Ibrahim are saying, oh, you're going to live 20 years post-retirement because you're in London. How much do I need to save? No one can answer it because no one can tell me what is inflation next 20 years, what is equity premium next 20 years, where bond yields are going to be, where equity returns are going to be, and last of all, where do I retire? Do I retire in a village in India? Do I retire in a city called London? Or do I retire in a village in UK? And because of these things, we really need to look at these things on a rolling conditional basis. That is very, very important. Jarmo, again, as usual, wants to give the audience the best of content, just like Ibrahim. So he put me on the spot and he asked me, Amlan, what do you think happens to emerging markets? And I'm going to highlight another book that I've been showing IMF, World Bank, OECD. And this is a book where I'm on the advisory board. It's called Saving the Next Billion from Old Age Poverty. This is a charity, started as a charity. It's a non-profit which serves informal sector in Rwanda, in Kenya, in Philippines, in Costa Rica, etc. And the name of the company is Pinbox Solutions. So 1.8 billion out of 5.3 billion people are in the informal sector. They are left out of formal pensions. They are poor, particularly when COVID hits it. And I quote from the IMF, something that the IMF wrote in April of last year. I've been highlighting since February of last year. This COVID crisis will cost Latin America, Asia, and Africa up to a decade of growth, up to a decade. Why? Because a country like India has 91% informal labor, does not have a formal pension system. Costa Rica, 79%, Brazil, 73%. So when you have informal labor systems which can't contribute to pensions, people, institutions, households, and families need to save a lot more. If you don't save a lot more, then it is going to cause problems. So savings need to be higher. How do you save more? And this takes me to a few things that I highlighted in Age of Responsibility in my chapter. What I highlight is that savings of people should start very early. And it is linked to something where there's a chapter in this book on financial literacy, which also Bob Merton and others talk about. So to save more, you need to communicate with people, something that Ibrahim and Jarmo know very well how to do. They're doing it already in the Gulf. You need to communicate with people why they need to save more. They are living longer. GDP growth rate is low, and it's trending low in 73 out of 74 countries that I'm looking at, largely because labor productivity growth is low. To increase GDP growth, I have in the demographic manifesto, which has been recommended across countries, said, number 2 point is, let's be more gender equal. Because if we are being more gender equal, women are the most productive part of society which are not being fully utilized. If gender equality is there, you get 4 golden dividends. Number 1, growth goes up. Number 2, debt goes down. Number 3, sustainability increases. And number 4, inequality goes down. Also, we need to engage more youth. And that's where Ibrahim does fantastic work by incorporating fintech, by making people understand how technology can transform lives so that they are not scared about technology, whether it is to make payment systems, or it is to get loans, or it is to develop microfinance.
I think we have another round on that. It's very important. Technology as a different aspect, definitely.
Absolutely, Dr. Sherif. You are absolutely right. Also, in your country, I did predict when my student was the head of the Egyptian Stock Exchange, I did predict the Arab Spring, showing that youth unemployment is a much bigger issue in your country and in parts of Africa. That's also to do with education, human capital, and technology. So there are lots of rings that we need to look at. I want to end my comments just by saying two things. GDP, even in the Arab countries, GDP per capita is very, very different. Life expectancy is very different. Consumption and education systems are very different. So I will tell Jarmo something that next week at the Nordic Pension Conference keynote, I'm going to tell the Nordic 4 countries in terms of pensions. Denmark and Norway, life expectancy is so different that if I use the life tables of Denmark on Norway, the surplus ratio goes from 1.08 to 0.916. So we cannot think that even cousins or neighbors have similar kind of life expectancy. And conditional life expectancy is even more different. So life expectancy, Italy is very similar to Japan. But when you look at conditional life expectancy, Italy sometimes is higher than even Japan. So if you look at conditional life expectancy at 80 and you go to places like Bertinoro or Sardinia, etc., you will find that some segments out there are outliving even the Japanese. Yet Italy has the worst gender ratio, even worse than Japan. Japan is at 20% male-female labor force participation graph. Italy is at 21%. So those are some of the solutions, but to increase growth, and this is a very nice paper that everyone should follow. It's from the Arab Monetary Fund, which show that over the long run, an increase of GDP leads to 1.6% of savings. But an increase of 1% in savings leads to increase of less than 1% in output. But in the short run, you have much lower multiples. 1% of increase in GDP leads to 0.6% increase in savings, but 1% increase in savings generates 0.034% in output. In more technical terms, we can say that growth, Granger causes savings, that growth has a bigger impact on savings than savings does have on growth. And households with high income growth tend to save more than households with predictably low growth. But most important thing I want to end with is behavioral changes. To change behavior, we need more communication, and finance and economic theory is changing from when Jarmo and I and Chiara and Dr. Sherif got the degrees, from Cobb Douglas to habit persistence models to non-time separable utility functions to also utility functions which are not homomorphic but which change along with different shocks. And on that note, I want to say savings all over the world has increased during this crisis, except for in countries like India, Brazil, etc., where they've drawn down on savings. But in the rich countries, we are likely to see a consumption boom. Let's not confuse rich countries' savings with poor countries' savings. Rich countries can afford to save precautionarily, but the bottom 20% in India, Bangladesh, Indonesia, Cote d'Ivoire, or even Zimbabwe, they cannot afford to save that much for precautionary things. We really need to encourage them through the government to save more. And with that, I hand it back to you, Dr. Kotilaine. Thank you.
All right. Thank you very much, Amlan, for that global whirlwind tour, as well as a comprehensive literature review on the subject. I think that gives us a good backdrop. It has also given us a little bit of a challenge, which is that it's now 22 past the hour. So let's improve all on the timekeeping. Some of these issues that you raised give a nice segue to Chiara's background and experience on the subject, which is, of course, one of the great paradoxes is, as we all know, that people need to save precautionary savings, save for their old age, etc. But when people are left to decide by themselves, they don't necessarily do that. They act in ways that are irrational, that are myopic. And of course, this goes to the issue of financial literacy, financial education. This is an area where the OECD has done a great deal of important work. And Chiara, if I may, I would like to ask you to discuss some of the lessons from the International Network on Financial Education, as well as your recommendations on financial literacy.
Thank you very much. Good morning to everybody. Let me thank again Fintech Robos for the invitation and Dr. Kotilaine for the very nice introduction. So, as was mentioned, I will bring the perspective of this international network on financial education created by the OECD, which is a network of public authorities interested on the topic. And we have membership from more than 130 countries. So it's really global and much broader than OECD membership. And the points that I will share today are, of course, very broad and applicable in most contexts, but I would say they are especially important for Gulf countries who may just be starting to look into this issue and the related challenges. So as was already mentioned by Dr. Roy, financial literacy is a very important aspect to support household savings and developing saving habits. Of course, it is not the only public policy in this domain. There are many other policies and aspects, and financial literacy is not necessarily a silver bullet. But at the same time, it's important to develop this kind of policies in conjunction with also financial inclusion policies and financial consumer protection as a way to really empower consumers and households to take good financial decisions for themselves and for their families. And going back to what was mentioned by already Dr. Roy, it is especially important that individuals have not only adequate financial knowledge, but also the right attitudes, skills, and behavior. It's not just a matter of knowledge, of knowing key concepts, but really developing good behaviors and good habits. And especially in terms of savings needs to start early in life because of compound interest, and the same is true for financial literacy. Financial habits are developed from a very young age, and it's important to nurture these habits and help people develop them from a very young age, to start develop financial literacy, possibly already in schools, so that people can start to develop a savings culture. And in terms of what it is important to do financial literacy about, as I said, it's a combination of knowledge, attitude, and skills. It's important that people understand the characteristics of traditional, but also innovative and digital financial products, and especially around pensions and long-term investments. That they understand the idea of risk diversification, the balance of risk and reward, that they understand the implications of their financial decisions, not only for themselves and their family, but also on the broader society and community, and that they are empowered to take these decisions and choose products, especially in the pensions area, where products are particularly complex and there is a wide range of menus and the wide range of choices that people have to make regarding pensions and retirement, that they are able to take these decisions and make these choices in ways that are good for them, good for their families. This may not be the same, a good choice may not be the same for the same family or the same person, and that they take into account the complexity of these choices. And in some cases, it may be good to have also dedicated advice, especially to support people who may just be starting this kind of decision and may not necessarily be able to navigate the complexity of it. So I think I will stop here for now. These are just very general thoughts, but I will be happy to go more into the details during the follow-up questions. So Dr. Jarmo, back to you. Thank you very much.
Yes. Thank you very much. So we all have a very ambitious curriculum to cover if we want to get it right. And I think on this note, we'll zoom in on the Middle East North Africa experience, which of course goes back to some of the issues that Amlan was talking about that are common to many of the emerging markets, but takes us closer to the story in the Gulf. Dr. Sherif, how would you characterize the role of financial inclusion and consumer education in getting it right in this area in the Gulf countries, and what's the situation that we're starting from? Also, what is your assessment overall on the availability of solutions and products, and I suppose advice for something like this in countries where, to the extent that pension provision has existed, it has tended to be very much government-led and limited to the government. Yet we have these labor markets that have a substantial percentage of casual or informal labor that, if you like, flies under the radar. Over to you.
Thank you. Actually, you mentioned a lot of challenges, but in a few minutes, maybe we can address one. Our region is not homogeneous, as you know. We have relatively middle or poor countries. We have other countries with more resources, but we can also distinguish the fact that there is a significant expatriate community within the region migrating temporarily, predominantly. Let's say the Gulf versus North Africa and places like Jordan and so on. And this is a challenge. So even if we talk about the Gulf, you have a significant presence of people who might be earning for part of their career, but returning to their home countries, and their families are dependent on them. Also, as we're encouraging saving, I think we are encouraging regulated saving or formal saving as opposed to informal, because there are ways of informal saving that are either risky or limited by nature. As an example, in some of our countries, including in places like rural Upper Egypt, you'll find a main saving for women, as women were mentioned, was buying gold chains and bracelets and so on. So you'll find them walking around with their savings around their wrists or their necks. It's a way to save, actually. And supposedly, looking at gold prices over the last, 40, 50 years, they were smart investors, at least in a place like Egypt. It helped them hedge against devaluation, against inflation, and so on. However, the challenge is now, other than those informal savings, it's more important to have formal ones. In some countries where we have taxes, income taxes, then savings incentivized by tax breaks becomes relatively easy. In the Gulf, we have no income taxes, more or less, so it's not one of the tools you may use. Also, as probably the OECD reports and statistics mention, and other entities, the Middle East, the MENA region, is the lowest in the world in terms of financial inclusion, even lower than Sub-Saharan Africa, Latin America, and so on. Having said that, this is one of the key challenges to helping people save formally, because by default, if they are financially excluded, they don't have a bank account, they do not have a mortgage, or even getting any sort of formal credit. These are all in the pot of challenges. Very important, so as not to take too much time, is to have credibility. I mean, even if you do education, you do awareness, we need to have credibility of the institutions where they can save at, because it's without the credibility, people will always be fearing something will happen to their money, or it's too little what they have, or a bank is threatening to them, and so on. Also, Dr. Roy mentioned interest rates and so on. or how much I would save for the coming 20 or 30 years. Maybe in advanced economies are more stable, inflation rates since ages have been manageable. The real challenge maybe is negative interest rates now, not the inflation. But in many countries in our part of the world, inflation and exchange rates and commodity prices they rely on are so moving and oscillating that it is becoming a challenge to really have any one budget how much you could be living on 10 years from now. We've all had horror stories. Governments had to stop it. I've seen one of the questions being sent to us as a panel, what happens if somebody doesn't save? Actually, the state is ultimately responsible for everyone. So we've seen in countries like Egypt, if you did not save, if you're not part of a pension system, they would guarantee you a minimum amount just to survive. We can't just tell somebody, tough luck, you did not save, we're not responsible for you. He won't be living adequately, but at least he will get enough to survive. This costs the state a lot. It opens room for abuse. So we have all the incentive to really attract people early on in their life, as Mrs. Monticone mentioned. Just to wrap up, looking at the various schemes, and I've found personally that the peer pressure and having an example helps you save. Other than state pension, which in many emerging markets are limited and are not that generous, but I've found that the private pension schemes for people working in the same profession, in a syndicate, in a company, in a bank, and so on, has the highest participation rate. If you go into a company or a school for teachers or whatever, and you try and sell them an insurance policy, maybe you get 1 or 2 buyers out of 100. But when you step in and you're unemployed in a farm or in a university or an electricity company, and you find that all your predecessors have willingly, let's say, contributed 2 or 3% of their income in a private pension fund to which they elect a board and they see the accounts regularly, people don't think twice. This has been extremely successful in a country like Egypt, plus, of course, having a deduction on your income tax, which doubles your incentive to save. Thank you very much.
Thank you very much. Now, that's a very helpful backdrop. I promised you something on the Gulf region. Regrettably, Dr. Hannah does not appear to have been able to join us. So let me briefly step in. I think a lot of the background has been covered, but I think the reality is that the Gulf region, the Gulf countries have a lot of idiosyncrasies when it comes to long-term savings and pensions. A lot of this is culturally conditioned, and a lot of it is historically determined. Old habits die hard. And what are the 2 historical legacies that I would like to highlight in particular? Number one, the oil booms of the past turned these societies into consumerist societies. The people are good at consuming. Sometimes with borrowed money, they are less good at planning their long-term financial future. And why is that? Because, of course, the oil booms that created this consumerist culture also created wealthy governments that then, for a whole host of historical reasons, were seen as the ultimate guarantors of people's welfare and security. The Gulf pension schemes are not particularly old. Ibrahim, correct me if I'm wrong. I think the oldest ones are from the mid-50s. Many of them are much younger than that. The coverage of those schemes is not necessarily all that high. They were initially for civil servants, and in many cases, the coverage of private sector employees is still quite incomplete and uneven. Of course, there are some of these issues of informal labor that Sherif was talking about as well. We are at a point today where, generous as these schemes have been over the decades, they are all running actuarial deficits. In other words, at some point, continuing the way they have been doing, they will run out of money. And what this has pushed all these entities to do is start tweaking, start engaging in what we would call parametric reform, pushing up the pension age, reducing the benefits, reviewing eligibility criteria, etc., etc. I think this is very important in terms of conditioning behavior, in the sense that people are increasingly beginning to see that the old assumptions about government generosity probably are no longer valid. Where things get more interesting is that explicit alternatives do not really exist. In other words, many countries have legislation, regulations on occupational pensions, voluntary pensions, how these need to be governed, disclosure requirements, etc. This, by and large, does not exist in the region. There are some provisions here and there in the labor laws, for instance, in Saudi Arabia.
Dr. Kotilaine, allow me to interrupt you, but as you know, the challenges could be tamed with the change from defined benefits to defined contributions. So we all get ourselves out of being stuck. It might not be enough, but at least you will be honoring your commitments and so on.
I absolutely hear you, and that clearly is one of the challenges that we have, is that these schemes are historically and still today, by and large, defined benefit schemes. We obviously have the specific challenge of the end of service benefits for expatriate employees, which still overwhelmingly dominate, especially the private sector labor force in the Gulf countries. So the other pillars, if you like, of the pension system, by and large, don't exist. The literacy around this, by and large, doesn't exist. When people save, they save. I guess in some cases they save through jewelry, but for instance, many people save in real estate in a market that has become increasingly unpredictable, and on assumptions, for instance, on the influx of expatriate labor that may be becoming increasingly unrealistic. So they think they are saving, but whether their money is secure is a different story. So what all of this boils down to is that there is a pressing need for increasing financial literacy and also greater regulatory reform around this idea. So this sort of takes me to my next question, which is there's a lot to do. The kind of agenda that you've all outlined in your various ways, getting it right in terms of long-term savings. This is not an easy task. I mean, and not everybody has time like Amlan for a PhD in finance. And not everybody can be expected to figure it out themselves. So what is the role that governments should play in terms of getting this right? And I suppose in particular in terms of getting it right in countries where the governments up to now have not done all that much beyond these defined benefit schemes. Maybe we start with you, Chiara, on this one. What's your advice to the Gulf governments?
Of course, that is a very important question, and what do we need to do in practice? So I would say that there is a wide range of policies that countries can put in place, and I think it's a good idea to use a complement, to use various strategies at the same time. So first of all, as I said, financial literacy is not the only one, and it's important that countries also use other types of incentives. It can be fiscal incentives to encourage savings in certain areas or in certain instruments. This is being done in many countries where certain types of pensions receive tax incentives and so on. Financial literacy is one of those, and financial literacy can mean a broad range of instruments and actions. It can mean awareness campaigns. It can mean messages on TV, for instance. It doesn't necessarily mean need to be like long seminars or long courses. It can be messages at the right point in time when people need it, the so-called teachable moments when people are making important financial decisions for themselves and their families, to give them good messages and good hints on where to go, where to look for help. There needs to be, of course, a sort of an infrastructure of advice and help and guidance that people can refer to if they want to get more information or more guidance and more help. And as was mentioned by Dr. Roy at the beginning, it's important to keep into account that what is written in textbooks is not necessarily what people do in real life, and to use all the many lessons from behavioral insights to develop all these policies, both on the saving and tax and fiscal side, but also on the financial literacy side, and really test interventions to understand what would be more meaningful and more helpful for a particular audience or in a particular country, taking into account culture, social norms, and so on, to make sure that interventions are as effective as possible.
Great. Yes. Look, if I may, we've talked about the behavioral paradoxes already in this area, and sometimes the only way to get people to do what they need to do is to deprive them of the alternatives. Amlan, from your perspective internationally, to what extent do governments have to force people to get it right, and what is the appropriate way of forcing them? I think you're muted. You're muted. Amlan, you are muted.
Can you hear me now?
Yes.
Okay. So thank you, Jarmo, for a great question. Before I just get into that, I want to share with everyone what the granddaddy of pensions said. He invented 401k plans. And Franco Modigliani, on his deathbed, wrote a book, Rethinking Pension Reform, saying neither DB nor DC is the solution, and hybrid pension plans will do better. And these are some things that we have seen some very well-known Italian as well as Dutch professors talk about, that we need hybrid pension systems. Now, in terms of alternatives, what has worked in the developed world is something called nudge. So in UK, to increase pension savings and to nudge people to save a bit more, the UK government took on the consultant Richard Taylor, and the behavioral science unit of the government devised certain communications and experiments, tested it differently in different regions, and the nudge theory worked well. But I will give you an example from the opposite extreme, and they have been even more successful. In Rwanda, in Kenya, in Thailand, in India, in Costa Rica, the poorest informal workers have managed to, through digital mechanisms, easily explained, very easy, and this goes back to your point, one option, easily explained and shown, helps even the 80-year-old Kenyan and the 91-year-old Rwandan woman to put aside 5% of what their sons and daughters give them in an M-Pesa account or in a digital savings account. And that then becomes a habit with them, because those women, and that's where I want to go back to Dr. Sherif, he was absolutely right. It's not just literacy, it's access. So when the 80, 90-year-old women are dealing with financial savings on their phones, then the 5, 6-year-old grandchildren and great-grandchildren also learn. So the demonstrable effect is trying to be simple, not give too many choices which confuse, but public-private partnerships to incentivize people to save. And that, I think, has worked.
Okay. Sherif, let's move to you. In the MENA region, would you say there are examples of countries that are, if not countries that have got it right in this space, at least closer to getting it right than the rest? And what has the success formula looked like?
It's difficult to say who got it right or wrong, but let's say historically, or who has an elaborate system. I would say that due to legal issues, even historical issues in North Africa predominantly, there were major steps on that front. If I take two countries as an example, Morocco and Egypt. Egypt has been an early country to have insurance, to have even the first one to formalize regulation for financial services, whether capital markets or insurance, historically there. So I'll take it as an example. Aside from mandatory pension that are limited by nature, but we have an elaborate private pension scheme. We have an elaborate even microfinance and NGO scheme that sometimes encourage saving. Maybe not in PESA for the 90-year-old women Dr. Roy mentioned. The post office plays an important role as well. In Egypt, we have 20 plus million, which is more than 20% of the population, that are post office clients, and most of them don't deal with banks. So the post office has 4,000 branches, equal to the largest 10 banks in Egypt. It's giving good inclusion and good access as well. Of course, with technology, with mobile wallets and so on, you are attracting new generations. But the post office, in my opinion, and the agriculture banks, as Dr. Monticone was mentioning, education and accessibility and so on, is important. Even real estate, I heard real estate, of course, but real estate is an option for those that are maybe middle income or more. It becomes more challenging for the small people. But we still, I think, need to give them exposure to real estate. Hence, the concept of REITs or real estate investment funds could be a way for, you can't make a decision if you have $20,000 or less, but you can be part of it. I think some Gulf countries currently have REITs. Egypt is building it. So again, there is no solution. There is an aspect of digital inclusion, having your mobile. I mentioned at the start of our talk, a large expatriate community from Jordan, Egypt, Sudan, Lebanon, other countries in the Gulf. These have to start formally saving when they are having their higher tax-free income in the Gulf. Hence, it's very important that between regulators, insurance regulator, pension regulators, we tie such individuals to their home countries, whereby when they come back, they have a nest. Maybe even they have an extra incentive because their savings are in FX, in dollars or whatever, which the other countries are willing to even attract further, so they can get even more incentives and tax breaks. So there isn't one solution. I think we're on the right track. The big challenge, which I'm closing with, is casual labor and those who are like what we call now gig economy, freelancers and so on. They are predominantly out of all the schemes we described. And these people, when they're unemployed, and they always have a lull or a period of unemployment in between jobs, would tend to rob the piggy bank, as they say. So hence, whatever they saved for retirement really works as standby in between jobs. And this is a challenge that we really have to address, how to attract and organize without being too forceful. A lot of young people now that are doing software development, builders that help in agriculture season. This is the nightmare or the headache to whoever is worried about that scheme. Thank you.
Thank you very much. One question that has come up in the questions from the audience is this issue that you touched on of these migrant workers. And of course, we have migrant workers within the MENA region, significant numbers. We also have people coming to the Gulf, especially from Asia, but really Dubai is very much seen as a deliberately global destination now. And in some ways, this remains an understandably politically and socially controversial issue, the view that people remit their money back home, the local economies don't benefit, etc. Is there a way we could make this work for everybody? The reality still is the private sectors are overwhelmingly dominated by expatriate workers, and nitaqat or no nitaqat is not changing anytime soon. What would you
challenging to say the least, because we've been seeing even countries trying to put limits on how much you can repatriate some of the countries. It's a challenge, but again, having long-term investment instruments, they have to be channeled back. I mean, you don't go as an expat so as not to channel back. However, while you're there, you might be contributing to savings in some instruments, and then they can allow you to repatriate when you leave. I think there should always be a compromise. And it's not only saving, but as you know, this is a topic for another discussion, life assurance as well could have a significant saving component, unit-linked policies and so on. So you might achieve more than one objective, not only saving, but saving and assurance, because if something happens to you, your family needs to be provided, so it's indirect. So again, it's promoting literacy in insurance, in pension, even if we don't really call it pension. You need to have money somewhere. And sometimes one of the incentives is to allow you occasionally to borrow against such savings when you have an emergency, or somebody's marrying his daughter, or moving to a new house. When you feel you could have access to cash reasonably, using it as a guarantee or long-term savings, it might give you an extra assurance on that.
Okay. Now, you've mentioned, and I suppose all of you to an extent, the issue of technology. And of course, this event is hosted by Fintech Robos. So let's pay heed to an issue that is growing in salience and is in many ways disrupting and transforming financial services worldwide. Let me start with you, Chiara. What would you say is the potential of financial technology, fintech, in terms of addressing these challenges that we've talked about, with specific reference to emerging markets, of course, but I realize a lot of these issues are global issues.
Yes, thanks indeed. Digital technologies are becoming, especially now during the COVID crisis, they are becoming sort of a new normal, both in terms of accessing and using financial services for digital payments and transactions, and also in the way that communication, information, and education is shared. A lot of financial education has gone online and is probably going to remain this way for a long time. And this, of course, offers great opportunities for reaching people who were not necessarily already in the financial system, who were living in remote areas, who can, as Dr. Samy was discussing, who can exchange remittances and so on. But at the same time, this may create new forms of exclusion and new divides for people who do not necessarily have access to digital tools or do not have the digital skills to use them. This is a whole new set of skills on top of the financial skills that are increasingly being required to interact with the financial system right now. And some parts of the population, especially the elderly, I know population in Gulf countries is relatively much younger than in Europe and other countries, but still there may be sectors in the population who are not necessarily familiar with these technologies, and they may risk being excluded in a sense from the opportunities that are given by these new technologies.
Do you think that governments, regulators should deal with or embrace or leverage these new technologies differently? Let me give you just a hypothetical example. Sometimes we don't ask certain questions because we think we might not like the answer. Okay. Is there a need, for instance, to force people to say, okay, this is how much money you have saved up. this is what your future will look like, because that obviously is one of those things that technology can now let us do quite easily.
Yes, indeed, that is a very sensitive and sensible point. And indeed, many countries are being very open and using technology to disclose as much as they can projections on pensions, for instance. And some countries they know very well that they should do it in a sense to give more transparency and information and to let people, to allow people to decide and plan ahead. But at the same time, they're reluctant to do so because they're a way of disclosing a time bomb related to future pensions and levels of future pension benefits. So governments can use these tools and opportunities wisely, in a sense, and at some point they will have to communicate around those issues if they want people to be aware and ultimately take decisions. One of the previous questions was about mandating savings. Of course, this is a clear and quick way of reaching certain saving targets, but at the same time, mandating may not be optimal for everybody, and whatever is mandated may not work for everybody. So ultimately, people also need to some extent, without necessarily being exposed to decisions that they are not able to make, but to some extent, they need to have some freedom and some responsibility to make some choices by themselves, depending on their own personal circumstances.
Okay, Amlan, as the Gulf governments sort of look for a way out of these pension challenges that are mounting, who should they look to as a model?
I would highlight two countries. One is Rwanda.
Okay.
And I want to go back, you didn't ask me, but this is, William Price is going to speak later in the conference. This is a fintech solution across 9 emerging markets countries, working with regulators. And I want to pay a very big tribute and salute to the OECD to have galvanized in Europe and in other parts of the world the best practice on savings, communication, access. So you're right, what we need in the Gulf countries is financial literacy, access, and communication. But regulators in Rwanda, in Kenya, in Thailand have played a bigger role than in Zimbabwe and South Africa. That has engendered what Dr. Sherif said, public-private partnerships. And thanks to the digital app, now in Rwanda is number 4 in gender equality, number 6 in terms of digital apps in the world, financial literacy. All this happens because they speak to World Bank, to OECD, to others to try to understand how can we, from a very low base, become more financially literate, get better access, and communicate better. So I think regulators, as you rightly said, and Chiara mentioned, Dr. Sherif mentioned, are critical in this whole thing. I would say the most progressive regulator in financial literacy are those in Kenya, Bahamas, as well as Rwanda.
Great, thank you. We are nearing the end of our allotted time, so let's do a closing round of questions and before my final remarks. From each of you, since this is a conference in the Gulf region, well, sort of. I know we are in all different corners of the world, but never mind. What is your overriding one piece of advice to the Gulf governments in terms of how to start making real progress in the right direction? I know there are many things you want to say, but I would ask you to limit to the most important one from your perspective. Let's start with you, Sherif.
I don't like to force people, but incentives, if there is a long-term co-contribution of some sort, whether it's financial or in terms of housing or even medical. Let's remember, part of saving is you save for more medical bills when you grow older. So it goes hand in hand with whatever universal health care is there. So I would encourage people to do that. And I will use one message telling them a lot of people in the region relied on family networks, solidarity over generations instead of formal saving and support. With new generations, with technology, life is changing and it will not be the same. So one is an incentive and second is a warning for our grandchildren and children.
Okay, interesting. Obviously, incentives are a bit difficult in countries where you don't have much by way of a tax system, but I think this idea of linking things to the welfare policies or government
or a top-up, top-up
yeah,
would help you to save support.
Very good, very good. Chiara, your piece of advice.
Yes, so I think I have a very broad piece of advice that applies to many types of policies, but I think in the context of Gulf countries can be especially helpful. And so at the OECD, we always like to talk about evidence-based policies. And I think for these countries, it would be very important to start from a diagnosis to really understand what people would do and start with small pilots before doing like larger scale interventions. As was mentioned, incentives can work, but we do, because this is in a sense is a developing market in the sense of developing these new types of solutions. I think it's really important to start by collecting data and evidence and try to understand first what would be the most meaningful way to go by talking to people, by talking to policymakers, by talking to stakeholders and bringing all the views together.
Thank you. Amlan?
Thank you. I hope you can hear me. So
yep.
I will give the same advice that I give in Latin America and Africa, that in the Gulf countries, each country needs to understand heterogeneity. Their savings rates vary between 30 to 52%. Their GDP per capita is different. Their GDP growth rate is different. Literacy is different. So every country should look for best practice, but adapt according to their own conditions, taking into account that education, access, communication, and partnership are crucial. And I want to end by quoting Benjamin Franklin. And this is what African governments which are successful have done. He says, "Tell me and I forget, teach me and I remember, involve me and I learn." So the success of microfinance and of savings has to be involving people through better communication.
Thank you very much. I would like to thank all the panelists for their insights and helpful comments. It's always frustrating that we can't get deeper into these topics, but time is limited. I think we've covered a lot of ground, got a lot of insight. This is clearly a conversation that will have to continue for a long time to come and grow in multiple ways. If I can answer my own question, I think it's important for people, for individuals, and for governments to start thinking of this as a positive opportunity rather than a negative, undesirable, embarrassing thing. So let's not apply what I call the Frank Sinatra philosophy of trouble, don't touch it, maybe it'll go away. But think of this as a way to educate people, let them take charge of their financial and their families' financial futures, better understand what is possible. I think the opportunities that Ibrahim and others are opening up with fintech are fantastic in this regard, because it makes it much easier to share information, analyze information, and overcome some of these informational asymmetries that we've seen in the past. But also from the government perspective, unleashing the power of collective savings, creating new products, creating new vehicles for sort of pooling and allocating capital is critical for the diversification agenda and the long-term productivity and growth needs of these economies. So this is something that has to be done, and there is a way to turn this into a win-win for all concerned. So on that note, I would like to thank the audience and thank my panelists, thank Fintech Robos, and wish you a very good rest of the conference. Thank you.
Thank you, Jarmo. Thank you, Sherry. Thank you, Chiara and Ibrahim.